Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, April 20th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I am not a financial advisor. I cannot give you individual financial advice. Anything that you hear or see is for informational purposes only. Please do your own due diligence. It's your money. It's your responsibility. Okay, this week I have basically just a lot of, not necessarily a main theme or anything, but just a lot of slides that came through, kind of expanding on some themes that we have already talked about in the past. So from Jesse Felder on Twitter or X, basically, is gold front running the Fed? And, we saw gold make a new high, I believe, this week. I think it's over $2,400 now. And I've seen a couple people say something similar to what Mr. Felder says in this tweet. He says, the Fed faces an invidious choice: stay the course against inflation at the risk of a U.S. funding crisis, banking crisis, recession ending in a return to QE and physical dominance, or cut rates before inflation is under control, ending in physical dominance. So basically, it's what has been talked about by many folks in the past. The Fed basically is in a, damned if they do, damned if they don't. It seems apparent now that because of several factors that are all conspiring to keep inflation above where the Fed wants it to be, i.e., the fiscal spending that's going on by the government, the pullback in globalization because of the proxy wars and other things that are going on with the U.S. trying to hold on to its hegemon around the world, demographics. There's so many things that are conspiring to keep prices higher than they should be. I think one of the main things is just in the U.S. at least is the federal government's just spending too much money, and there's too much money chasing too few goods. And I don't see, I've said this before, I don't see any discussion by either of the two presidential candidates or anybody in government for that matter advocating for cutting spending. And so I think that's going to continue. You're basically, running deficits of 5 to 6% of GDP, which is something you would expect to see in a world war type situation. So yeah, I think gold is front running. Obviously, central banks have been buying gold. We've pointed it out over and over, and I think I have even a chart in here this week. Retail investors in the West are not buying gold. The gold is going from the West to the East. And we've talked about why that is, and I suspect that's going to continue because people that used to hold U.S. Treasuries as their reserve asset in their central bank are going to be less likely to want to do that for geopolitical reasons and also for economic reasons. The U.S. is just totally out of control, and all the things, these things take time to get into, become the new mindset. They don't just happen overnight, like on Monday or Tuesday, everybody just wakes up and says, oh, you know what, the U.S. is never going to cut rates, or the U.S. is never going to get its spending under control. Here's all the math with all the entitlements. No, it's just one person at a time, gets converted. And then over time, it just becomes the new narrative. It just becomes obvious. I've said this before, the U.S. and the West altogether is running on fumes. It's running off inertia that was created by generations before us. And so I'm not going to get into that again, but that's my view. The entire West is in debt. The entire West is aging. The entire West is not replacing itself. The entire West has made promises and taken on obligations that it can't pay. And now it's struggling against up and coming a new geopolitical regime that it can't do anything about because of the sclerotic leadership and weak leadership. And basically, a people in the West that are, their values are not not consistent with people, that they're just rolling over and playing dead. So we have a lot of things going on, and I don't really. Okay, so Israel sends some drones or cruise missiles to Iran. That's not really the driver of gold. These are longer term phenomenon. Basically, what it comes down to is the fact that we have a bunch of promises that we've made in the West to people that we can't pay for. We're in debt, and all roads lead to monetary debasement, and I think people are sniffing that out, and that's where we're heading. So this is from U.S. Global Investors. This is the history of gold breakouts. You can see other times when gold has broken out, what has happened. I mean, it's obvious that gold has broken out of a multi-year basing period. That doesn't mean it can't pull back. That doesn't mean that it's going to go straight up. But I think, this is why I'm bullish on gold long term, why I've owned gold, and why I've kind of recently, over the last 6 months, started to move into the miners. And yes, the miners have not participated. They have not given the historical leverage to the gold price that they normally do. They are starting to move a little bit, but again, that's going to have to be another mindset change. Again, it was the same thing with uranium and these other things. It takes time for people to, get disabused of the fact that Nvidia goes up every day, and that current stock market bubble. And I would suggest to you that that is coming to an end, and we're going to see a rotation into hard assets and gold. So I wasn't aware of this. This is another chart from U.S. Global Investors, the amount of large mergers and acquisition mining deals in 2023. And one of the things that is a concern, not necessarily a concern, but it is prevalent at the large mining companies, is they haven't invested in new reserves. They haven't spent money. And they've done that because they've been in a period of lower metal prices, cash flows were constricted. So one of the first things that gets cut is exploration budgets. And so obviously these are depleting assets, so they have to be replaced. And so if you haven't, exploration, greenfield exploration takes years and costs lots of money. And if you haven't been doing that, you can't just turn it on in 1 or 2 quarters and fix the problem. So what we're seeing is mining companies going out and doing deals, mergers and acquisition, to grow their reserves on Wall Street. We've seen this before many times throughout the history of resources. We've seen it in oil and gas. We've seen it in mining before. And I view this as a positive thing, right? Because what you're seeing is companies buying each other up or merging, and that, takes more companies off the board. But there's a limit to how far that can go. And so that's where I always think that in these cycles of mining, as you work your way down from the majors down into the intermediates and then finally into the juniors, where they're raising money and going out and doing exploration. And I think that, eventually we will see a tremendous bull market in the juniors. I'm not saying it's, going to start next week, but eventually that money will come in there. If in fact the gold price, if metal prices continue higher, we're seeing copper, has moved fairly well lately also. So this is one of the themes that I am thinking about, is just the lack of investment. And I have a slide in here from Rio Tinto's chairman later on that he's pretty frantic about that also. So here's a chart from Tavi. So these are gold and gold miners percent of total global assets at different points in time. You can see these are times when they've been above 20%. You can see right now that we're at 1%. Everything's financialized. Everybody's in financial assets. Everybody's in tech. Everybody's in AI. That's where the interest is. And I suspect, again, that's what's overvalued. That's the page one story. I'm not looking to put money into overvalued known stories. I'm looking to buy things that I consider undervalued and that nobody else is talking about or interested in. I think that's where the opportunity is, and that happens to be in mining and in gold mining in particular. So I look at this as positive. This is from the U.S. Mint. This is U.S. investors shy away from buying gold. March sales for American Eagle gold coins were the lowest since 2019. Maybe they weren't a record, but they're the lowest since 2019. You can see, retail is not buying gold coins. This has been pointed out by several people. You're seeing the gold ETF holdings go down as the gold price goes up. People just have not woken up to what is happening in the gold market. They have no confidence that the gold price breakout is going to hold. So the view is, well, why would I get into gold? This breakout's going to fail and it's going to underperform like it always does. And I think personally that that's an incorrect view. Obviously, there'll be corrections, but it's obvious that there's been a substantial breakout above the basing period we've had that's taken many, many years. And if you put that into the context of the fact that no matter what the Fed does, it's trapped and all leads, if they hold rates, if the Fed holds rates where they are, I mean, you see like they're having trouble selling treasuries now, long-term treasuries. They hold rates where they are, something's going to eventually break in the economy. We're seeing housing is falling apart. Okay. Credit card delinquencies are at records. Auto loans are at records. Our defaults are at records. So we're seeing the stress. We're talking about that bifurcated economy again, right? And I didn't have the chart up here, but somebody showed like the initial claims data for like the last 10 or 12 weeks. It's all been around 212 or 214,000. How can it be that consistent? So I don't believe a lot of the data. I'm not saying that they're rigging it. I just think that their methodologies don't capture what's really happening in the economy. And, I just think that eventually this economy, as the excess liquidity wears off, you're having this push and pull. Are the higher rates going to exert enough downward pressure on the economy, gravitational pull, if you will, or is the fiscal spending enough to pull it away from that, falling apart? And that's why I think you're seeing this bifurcation in the economy where the people that have assets are doing well, people that have higher paying jobs in certain industries are doing well. And that's about, 30 or 40% of the people, and everybody else is struggling with the higher prices. They're just getting decimated by food costs, rent costs. And you just see the videos all the time, people making examples on TikTok and YouTube. So the Fed, if they hold rates higher, they cause a recession, right? Or something breaks, like some banks or something in the financial markets, then they have to come in and do a massive QE. And if they want to start cutting rates like they're talking about, well, they haven't hit their inflation target of 2%. And so do we just say, well, 3 to 4% is the new normal going forward? And, if you start cutting rates, I mean, as I've said before, the Fed wants to cut rates, believe me. But like I said, they're looking for that air cover. And I think that's what a lot of these hard assets are sniffing out. That, and in the meantime, the debt continues to grow, pile up trillions of dollars. You're running basically $2 trillion, $1.5 to $2 trillion deficits a year, and you haven't even had a recession yet. I've said this before. If we do get into a regular normal type recession, you could easily see a $4 trillion budget deficit in 1 year. And that just gets piled on top of the debt load that we already have. So yeah, I think that gold is anticipating this, and Bitcoin to a certain extent, but it's pulled back recently. But I think liquidity has tightened recently. It's tax season. I had to write a big 5-figure check myself. That takes the wind out of the sails of liquidity. So we'll see what happens. And after we get past this tax season, and we'll see what the Fed does. But right now, I mean, They're holding rates where they are, and interest rates or interest on the debt is just spiraling straight up. It's well over $1 trillion a year. If they don't cut rates this year, it's going to be a 1.5 to 1.6 trillion. It'll be one of the biggest, if not the biggest, budget item on the federal government's budget. Will be interest on the debt. That's banana republic stuff, guys. And the desire for people in the market to buy long-term treasuries. Who's going to loan the government when they're running that kind of deficits, when they're running that kind of fiscal irresponsibility? That's why the Treasury's selling all the short-term bills and not being able to sell dated notes and bonds, because no one's going to buy a 10-year bond and get paid. There's too much risk there. So at some point, like I said, we're going to end up with cutting rates. We're going to end up with yield curve control. We're going to end up with a lot of things. I think it's hard to predict the timing, but again, I think that's what the market does. It looks ahead. It doesn't look backwards, guys. And I look at this as a great indicator that retail is nowhere near gold. They have no interest in it. So this is what I'm talking about. This is the national debt. They have the debt clock. Here's U.S. federal debt to GDP. You can see back in 1960, it was 52. 1980, it had actually dropped. And then, since 2000, we went from 58.2%, 26% of federal debt to GDP to 122%. This is the interest on the debt net, but it's actually over $1 trillion. So there's a comment here that says, with 17 trillion in treasuries to be refinanced this year at 5% versus 0.5%, the interest on debt is about to rocket by more than 700 billion, taking the interest expense to 1.5 trillion, surpassing defense, Social Security, and nearing Medicare, Medicaid. So there you are. I mean, and again, in the comments, feel free to point out, where is the call for fiscal responsibility? They're ginning up another $60-80 billion sop to the defense industry and to Ukraine and Israel. Where's that money coming from? It's going right into that upper left-hand corner, U.S. national debt. So again, people say, well, so what? Yeah, so what? It doesn't matter till it matters. And then that's all that matters. This only ends one way, guys: monetization of debt, where the government, Fed, or the government, the Treasury, however they end up doing it. And that's how you end up a place like, Zimbabwe or Venezuela or Argentina or something like that. It's banana republic type stuff. And, as you get, as the value system of the people decreases, people don't want to live within their means. They don't do it in their personal life. Why would they expect their leaders to do it with the federal budget? So here's what I was talking about earlier: credit card balances, percentage of balances that are past due. Here's your 30, 60, and 90. I mean, you're at records. You're way ahead of the 2008 levels. And that's what it is. People are trying to live on credit cards because they can't afford, inflation. I'm talking about, middle class, low, working class people. Their wages are not keeping up with the price increases and the cost of living. So they're forced to do what they have to do. Now, have I analyzed every person's budget to see if they've cut back or whatever? No, I haven't done that. But this is what you would expect people to do. They're going to spend as long as they have access to credit. And once you become delinquent and your credit rating drops and your credit card company doesn't allow you to spend anymore, then what do you do? So there's a new uranium fund I wanted to talk about, and I'll tell you a little bit about it here, and then I will explain why I think this and the next slide are very important for uranium. It says an investment company in Luxembourg has created a wide-ranging nuclear energy and nuclear fuel-focused investment fund known as Triton for institutional and large private investors seeking to take advantage of growing interest in the energy source. The Triton Fund sponsors want to ultimately provide a way for accredited investors and institutions to invest directly in uranium mining as well, which will give investors access to the start of the supply chain. The fund could, on behalf of its investors, take a private equity-like position, as well as supplying debt funding. It even sees the possibility of getting involved in support of a broad public-private partnership to deploy small reactors. So if you read the article, it talks about basically this is institutional money. This is large family offices, accredited investors, and they have a mandate that they can invest in anything nuclear related. Public-private partnerships, SMRs, new technology, your physical uranium, mining shares, what have you. And this, guys, is exactly what we need for the next stage of the uranium bull market. We need a funnel. We need a way for the big institutional money to come into this market. Big institutional money isn't going to buy, XYZ uranium company on the Vancouver exchange. It won't move the needle, and they can't get a big enough position. And so this type of fund is what's necessary to bring the big money in. Okay, and these are going to be sophisticated people, sophisticated investors looking at ways to get money into this, what is obvious now to everyone is a long-term opportunity. So that's why I think, we've kind of plateaued out recently, because yes, all the fundamentals continue to get better, but everybody's getting frustrated. Well, that's because you don't have the push of the big money, institutional money coming in. I think that's changing. I think it will change. It's obvious that it will change. It's changing, and it will continue. So we'll get the big money in, and then that should, drag the entire sector higher to new record highs. I'm not saying it's going to happen starting next week, but this is a process, right? And this is what you want to see for the next leg higher. Not only this new uranium fund, but you have Credit Suisse, which is a bank, they're promoting uranium now. Uranium, a powerful element in the energy transition. So it just goes on talking about things that we already know about. And so you're seeing these large institutions now getting on board with the thesis, and they'll be going out to their clients and, hey, you should have maybe you should put an allocation into uranium, and this is a way to do it. We recommend, blah, 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 blah. This won't be the last two that we see either. And this will start picking up steam over time. And I predict that this is what we kind of needed to see for the next leg higher. Of course, there's a lot of consternation and wailing and gnashing of teeth on X from people that, are preparing to perform ritual seppuku because the uranium stocks and uranium mining thesis isn't doing what they want it to do in their particular time frame. Again, it's a patience thing. Nothing has changed. I mean, I say this till I'm blue in the face. Nothing has changed fundamentally, except for the fundamentals have gotten better. So you just sit, go to a ball game, go for a walk with your wife, go get a new dog. I mean, there's other things. Go read a book, listen to some music. I don't know what to tell you. Just sit back and wait. We're in a bull market. It just takes time. These things take longer than you think they're going to take. And one of the things I think that impatient, inexperienced investors do, or speculators, is they start thinking about all the wonderful things they're going to do, about how they're not going to have to go to that cubicle rat job anymore, and how they're going to be able to move out of their mom's basement and all this stuff. And so they need this to happen on certain time frames so that, the narrative that they've created in their mind can happen, right? So believe me, this will happen. I guess somebody put up, I made a video, maybe it was like 5 or 6 years ago already, talking about like uranium and how to play this market. I actually watched part of it. Somebody posted it. I think Justin Hune or somebody put it up there as a kind of way back, nostalgic look at, the thesis from 5 or 6 years ago. But, a lot of things are still in play there. And again, it's taken that long. I mean, if you got in then and you've held through there, your net worth should be fairly high at this point. So we're going higher. It's just a matter of time. Obviously, there's timing issues, but again, nothing has really told me to get off this ride except for, just the normal kind of evolution of a bull market, especially in such a small market cap industry like uranium. Remember, this is like a couple drops of water into a lake. It's nothing compared to the overall asset allocation. So again, as institutional money comes in, I think if that continues, which I believe it will, because the opportunity is so solid, that will be the next impetus, that will be the fuel for the next, step change higher in uranium. Just be patient. So this is an excellent slide. This was on a mining.com article. I'll try to put a link to it if I still have the link in the show notes. And it's the chairman of Rio Tinto. He's worried about the underfunded mining sector. This is exactly why we are invested in mining, why there's going to be a super cycle. It's not necessarily, yes, demand's going to be there, as that whole Fertile Crescent we've been talking about, that group of people of about 3.5 to 4 billion people from Istanbul to Jakarta, as they enter that S curve of lower middle class to middle class, and they get to a certain GDP level of $2,000 to $3,000 per year, which really accelerates the usage of energy and metals. That's what's going to accelerate it. But the big thesis for this particular super cycle is the tremendous underinvestment of hundreds and hundreds and hundreds of billions of dollars. That's not going to be rectified and remedied in 1 year or even 2 years. And so let's see what Rio Tinto's chairman says. It says low rates of investment in the global mining sector have put the global energy transition at risk, widening the supply gap in critical minerals like copper, Rio Tinto chairman Dominic Barton said on Monday. Quote, "The gap is humongous, and I am actually very worried about whether we will be able to close it," Barton said via video link at the Ecosperity conference in Singapore. Anyways, he goes on, it said, Barton said the world isn't just facing a shortage of minerals, but also a shortage of the capital required to dig new mines, which take far longer to develop than before. Quote, "The mining industry has reduced its investment significantly since the 2015 to 2016 period. We're hundreds of billions of dollars below what we need." Well, there it is. That's the thesis. Do you understand that? Do you have the patience to take your positions and wait for the thesis to play out? This is something that cannot be fixed by passing a law in Congress or in a quarter or two with, this is a dearth of new discoveries that has been precipitated from a lack of investment. And so what we need to see, what we will see, this will get solved. How will it get solved? By the prices of these necessary raw materials going to a sufficient level and staying there for a period of time that will pull capital in, because the returns for the companies that do have the resources will be so high that will, economics does work. Free market capitalism does work. Price signals work. We use these cliches, we use these little funny sayings. The cure for low prices is low prices. Is low prices. The cure for high prices is high prices. So when you have low prices, you're not investing. And again, extractive industries are extractive. You're pulling things out of the ground. And so in order to stay in business, you have to find new resources. If you're not investing, you're not replacing what you pull out of the ground, at some point you go out of business. I mean, this is about as simple as you can make it. And so the problem again is it's not going to happen next week. And so people don't have the ability to sit there, understand, cultivate this. It's like growing some plants. I just put some tomato plants in. I'm not going to get tomatoes next week. You have to, water that. You had to weed. You have to, help them along as they start to grow. You have to put up strings and get the vines. You have to help them. You have to wait. Okay, there's a period that the plant grows, right? I mean, this all seems very simplistic and almost like I'm talking down to people, but that's where the retail individual investor trips himself up. He can have a conversation sitting over a cup of coffee or a beer Yes, I get it. I want something to happen. I need something to happen. I want something to happen. I got to have that dopamine release. Well, that's not how wealth is created. Wealth is created by figuring out what everybody else is missing and then deploying capital and then waiting for it to happen. And again, I've said this before. It took me a long time to learn this too. It takes longer than you think for these things to play out. You're talking 3 to 5 years type stuff. So if you can't do it, or maybe you're a trader, you're just going to wait for a breakout like Paul Tudor Jones and then jump in. Well, if that's your prerogative. But this right here is why I'm big on hard assets. And then you couple this with the rocket fuel of monetary debasement, where commodities are primarily denominated in US dollars, and they're going to be making more dollars. I can guarantee it over the next decade. Yeah, this is the place to be. So, I mean, they're basically end of the lesson. I mean, that's about as, can you be a master of your behavior and emotions? This is really, and I've come to think of it. Yes, I think that, it's not a matter of finding these opportunities. It's not that hard if you're reading a lot and you're kind of cultivating a bunch of good analysts that you're following or other investors that really know what they're doing. It's okay. I get it. I just can't. I just want action. And so that's not really investing, right? That's gambling. And so I don't know. I'm not sure that everybody can do it. I think it might be something like being able to hit major league pitching or be a fast runner and be a wide receiver. I don't know. It almost might be something of a temperament thing. I don't want to use the word genetic, but something innate in a person that they either have it or they don't have it. Because if you look at all the great investors, they have the ability, and they're not 100%. People get tripped up. Even Stan Druckenmiller talked about that during the .com situation where he called it. He sold fairly near the top, and then it kept going higher, and he couldn't help himself, and he got back in and lost, a couple few $1 billion. And so nobody's perfect. Nobody's fully unbiased. No one's not swayed by FOMO and emotion. It's like, how much of it can you control, though? That's what it comes down to. So you have to be like self-introspective, and a lot of people aren't that way. Okay. So anyway, I thought this basically sums it up. I mean, there's nothing really much more to say. So again, wanted to show this. We've talked about this over the last couple of weeks. This is data center power demand increasing 8% to 8% of U.S. total power demand by 2030. You have to be careful with these type of linear extrapolations where some 24-year-old analyst, on the third sub basement sitting under a 40-watt light bulb is told by the research people, go figure out. I mean, because is that really going to happen? I don't know. It's not guaranteed. You can't predict the future. I do think that they're going to run up. A lot of this stuff is going to run up to some constraints around the grid, which is very rickety. Let's be generous and call it that. And that's why you're seeing, I read another article this week where I think Gates and some other investors were talking about doing like $100 billion investment where they build these nuclear power plants and put these like 1 gigawatt data centers in. And so I think that's coming, but who's putting up the money? Who's doing it? And so do I think there'll be growth in data center power demand? Yes. Do I think it'll just be this linear extrapolation? Probably not, because you're going to run up to grid problems and distribution problems. Putting the generation is not hard. People are throwing in solar plants all over the place. The problem is when I go out and look at it, people ask me to go out and look at a solar site. So yeah, it's this easy to build this site here. The ground's good. It's flat. The roads around here are good. The drainage is good, but then you go back and the development people say, well, we can't do that because where we were going to take the line, the gen-tie line to tie into the grid, there's no capacity on the grid. That's where you start running into. And so it's easy to throw up a solar farm or a wind farm in a year and start, kicking out hundreds of megawatts of power, and make money. And so that's a quick turnaround on capital. But who's willing to spend the billions of dollars to build a new transmission line and then go through all the hassle of dealing with all the landowners, the right-of-ways, the inevitable multi-jurisdictional permitting, the landowners getting right-of-ways signed. It just takes a long time. It's almost going to have to be like one of those things, kind of like during the Eisenhower administration, I think, when they just built they just made a, plan to build the interstate highway system. And you see the effects of that now and how it allowed for more efficiency in transportation of goods around the United States and people. I think you have to do something similar with, instead of spending money in Ukraine and giving money to Israel, billions of dollars, they should be, getting these nuclear power plants going and upgrading our grid and making it more resilient, robust, the ability to facilitate this stuff, which is going to create more economic activity and jobs. I mean, there's no solutions, right? There's just trade-offs, as Thomas Sowell said. So this is what we think is important in our country. We had this compromised Speaker of the House, evidently, this Mike Johnson, I believe his name is. He was against all of this until now he's all for it. He's a wartime speaker, he said. Well, who are we at war with? Well, we're at war with we're at war with the rest of the world because we're trying to hold on to our hegemon. And so, that's, if you listen to the Europeans, even Boris Johnson let the cat meow out of the bag this week because he said if the West loses in Ukraine, that's the end of the hegemon. He's absolutely right. That's what I've said since day one. The hegemon is collapsing. The BRICS, the emerging markets, the global South and East are on the rise, and the sclerotic, old, decrepit West is in decline. So, I mean, you should watch there. I mean, Shoigu, the defense minister, was at the Omsk tank factory the other day, and I don't see anything like this in the US or Europe. They had dozens of tanks being built. Okay. It wasn't made out of cardboard. It wasn't a Potemkin village. I mean, they show this stuff all the time. You don't see it. They don't show it on Fox or, where's Rheinmetall's manufacturing facility? I think we've had 3 ammunition plants catch on fire or blow up in the last 2 weeks in the West. I don't know what's going on with that. So, I'm getting off track a little bit. I am an America first. I'm for the people here. I want to solve problems here. And we have leadership in this country that does not like even the people of this country, doesn't care about them. It's an oligarchy, completely captured by big business, big banking, we've talked about this before. And until we change that, we're not going to be able to fix these kind of problems. Somebody went on a rant the other day, I think on YouTube or TikTok, and they said, this money that we're spending on all this stuff on these wars and everything. Again, Mike Johnson thinks he's a wartime speaker. We've not declared war on anybody. I don't know what war we're in. We're in a war to, suppress the population and make his wealthy donors more wealthy. That's what the war is. War against the American people. We can fix homelessness for 20 billion for veterans. We can fix the problems with the water situation in Flint. We can fix a lot of it. We can deal with this immigration problem. I'm not against immigration, but it has to be controlled. Right now, we just have chaos. Okay. And yet I just explained the debt situation and throwing money around left and right and have no idea where it's going. We got plenty of money for all the things that don't matter to most people and no money for what matters. And this is a perfect example. I don't think you're going to have this kind of data center growth just because the rickety grid won't be able to. That's why Amazon put that one data center right next to a nuclear power plant. There is no transmission problem. They're just going to tap right into the substation there. So anyway, that's kind of a little bit of a rant, but when people say they're America first, that's what they really mean. And there's no other outlet except for that one person who's probably not the best carrier of that message, but that's all we've got at this time. So we'll see what happens. I think, again, this type of issues create opportunities, right? And for people that have a different way of thinking, that aren't thinking like the mainstream. which is clueless, doesn't have a clue what's going on. So here's GMO, their asset class forecast for the next 7 years. I like to put this up monthly. Again, keep putting your money in, this is based on valuations. It's not guaranteed this is going to happen. This fluctuates month to month, but we've seen this consistently. Okay. Emerging markets and international is doing well. I have stocks that are doing very well from various emerging markets. I'm really big on Latin America. Things are happening down there. I don't think people are paying attention. And I think there's, I've talked about this before, there's opportunities all over the world. And with the ubiquity now of the internet and the ability for communications, you're not just stuck in your home country. You have the ability to access other markets that have, I think, better prospects than an overvalued U.S. tech sector. I mean, I think somebody showed a video the other day. Kathy Woods was being interviewed again. She was talking about NVIDIA, and she still had her $2,000 price target for Tesla. I mean, these people are put on TV still. And so I think this is where your opportunity is. And I think you should sell overvaluation and buy undervaluation. So want to put this tweet up. Money market funds just reached an all-time high, 6.1 trillion. These are cash and cash equivalents. Yeah, money market funds, T-bills, that kind of thing. 6.1 trillion is sitting on the sidelines enjoying high interest rates. But where do you think all of that money goes once the Fed starts cutting rates? It'll go back into the equity market. And then I think there'll be a rotation out of, overvalued tech as we have this sticky inflation and into value and hard assets. That's where I think it's going to go. But, that's my opinion. We'll see if I'm right or not. But in the meantime, I mean, there's really nothing wrong. If the long term, think about this. I've said this before. If you're somebody that's a little bit of a nervous Nelly and you're not really a speculator, you're an investor, your average return over decades in the S&P historically has been, with dividends reinvested, is somewhere between 8 and 9% a year. Okay. And you have years where you're up more than that, and you have years where you're down more than that. And there's been plenty of research on this. But right now you can get like 5% in a money market fund. The value of that fund doesn't change. It stays at $1. So you're getting basically 2/3 of the risk of the historical returns risk-free. So that's why I think there's a big attractiveness for many people. They're like, that are actually investors saying, okay, well, if the long-term return on equities is 8 to 9% a year, and I can get 5% risk-free, that's a pretty good deal. And so I think that will continue until rates get cut, and then that money will start moving out again into, well, I think, again, I think we're going to see, I showed that chart earlier where gold was only like 1% of total assets. I think that's going to go up over this decade or over the next 10 years. So this is a cyclically adjusted price to earnings ratio. This is not a timing device. A lot of people will criticize, they'll say, well, you can have periods where things are cyclically adjusted, PE stay low for a long time, and where they stay high. You see the overvaluation, the highest capes. This is more of a relative measurement to kind of give you some thought about where things are undervalued and what's overvalued. So what's overvalued? Denmark, India, the United States, the Netherlands, Ireland, Japan, France, a lot of the European countries. If you go to the other side of the spectrum, what's cheap in the world? Well, Colombia, China, Hungary, Poland, Hong Kong, Austria, Singapore. Again, I talked about that the other day, China being uninvestable. I listened to a pretty good podcast the other day about a guy that runs a fund in China, not the main shares like Alibaba. A lot of people are going in and saying, well, Alibaba and Tencent, I mean, these are very huge market caps, but this guy actually, is talking about companies that are like small and mid caps in China. And is the governance very good there? Well, there's questions about it, but then again, you still have Singapore and Hong Kong is available. So there's really a lot of cheap things going on, like I've said, in Singapore and in Hong Kong. And you just go down the list here. Brazil's cheap, Turkey's cheap, Korea's cheap. So that doesn't necessarily mean it's going to turn around, but you know, this historically leads to, over the long term, lower returns. Buying a basket of these will historically lead to outperformance. That's just the research. That's just historical. That doesn't mean it's going to continue, and it's not going to happen over, a 1 or 2 months. This is like a multi-year situation. That's kind of like how the dogs of the Dow works also, buying basically the top, taking the Dow and Jones Industrial Average is something like this, I think, where you buy the 5 highest yielding Dow stocks and then every year reevaluate and reposition back into whatever. And so you're constantly buying things that are out of favor and waiting for them to come back into favor. And that has outperformed the overall market. So there's been multiple studies. There's different ways to do this. Again, I think a lot of people that watch this program or subscribe to the newsletter are looking for, they're not necessarily hitting for average. They're slugging. There's batting average and there's slugging percentage. And with slugging percentages, multi base hits, doubles, triples, and home runs, right? So that's what people are looking for. And I think if you're talking about being an investor for the long term, you have to be aware of overvaluation and undervaluation. You can't be buying things that are on the front page that everybody's talking about on CNBC, because by the time you find out about it, most of the move is over. And so you end up falling into the same trap that we've talked about before, that plagues many investors, and why most retail investors underperform just buying a Vanguard, ETF, low, S&P ETF, is because they buy at the top and sell at the bottom. It just goes on and on and on. Okay, guys, that's it for this week. Appreciate the patronage. Everything keeps climbing. The Substack's growing. The video channel's growing. We appreciate the viewership. This is all happening because of you. We thank you. I'm very grateful to people. Like I said, I thought it was a good, kind of a fun thing this week where somebody dug up a video from 5 or 6 years ago when I was talking about uranium. And I thought that was kind of cool, and some of you folks have been with me since the beginning, and that's kind of cool too. So I'm grateful that people get value from this, and I hope to continue to provide it. So thanks again, and we'll talk to you next week.